Good afternoon, and thank you for joining us on this rainy Friday for New Administration, New Implications for Charitable Giving. I'm Barbara Garner, Donor Services Manager for Cobb Community Foundation. I've been with the foundation for almost 4 years now. I started as a resource manager focusing predominantly on operations before moving into my current role about a year ago. So we know it's tax time, full swing, and we hope this is a welcome break for you. We know you're meeting with clients and that they have questions about what you think will happen under the new administration. Given our role in trying to promote charitable giving done well, we would like to provide you with insights that we may have and give you suggestions on how to incorporate these strategies into the charitable planning that you're doing with your clients. So just a couple quick Zoom housekeeping items. We know you're doing this all the time, but we would encourage you to select speaker view in your upper right-hand corner. We wanted to let you know that we are recording this session for posterity, but don't worry, you're not on there. So if you're in your PJs, that's okay. Please submit any questions you may have through the chat. We'll also have a couple polls during the presentation, and immediately following the presentation, you'll receive a survey, just a quick one that we hope you'll take a brief moment to complete. So with that, I would like to introduce our fearless leader. You probably know her, our president and CEO, Sherry Martin. She has served at Cobb Community Foundation for 5 years. Actually 4, sorry. She was on our board of directors for 5 years before joining us, including 1 year as a board chair. One of her favorite responsibilities, even while she was on the board, was presenting to potential clients and professional advisors. And obviously that's something that she does all the time, still now. So before she joined Cobb Community Foundation, she had over 30 years in the wealth management industry with firms such as Trust Company Bank, Synovus, and Diversified Trust Company. All of that, of course, has been invaluable in her role with the foundation. So with that, Sherry, take it away.
Great. Thank you, Barbara. I appreciate the chance to talk to you. This is one of my favorite things to do. I always love chatting with folks about different planning ideas, and that was my favorite part of my job. So hopefully you'll find this helpful. So let me share my screen and we will get started. So, of course, this is the topic that folks are very interested in right now. What does all of this mean? And you and I all know that we don't really know quite yet what it means because there is nothing that has passed. Even what is currently pending has just had a major change announced this morning. As it relates to additional CARES Act dollars. So let me just jump in and let's start with where we are right now. So taxation at the individual level, we're basically looking at ordinary income tax. We've got preferential treatment for capital gains, long-term capital gains, and qualified dividends. We have the Medicare tax with the surtax on earned income that came several years ago, that extra 0.9% that's paid only by the employer. And then what I call the ominous net investment income tax, the NIT, that applies with AGIs over certain levels. So what do we think is going to happen next? I don't know if any of you are members of the Atlanta State Planning Council, but Sam Donaldson is a tax law professor at Georgia State School of Law, and he presented recently on this topic. And there are numbers being thrown out all over the place. And one of my questions was, okay, so we keep hearing this number 400,000 yet, and it being associated with the top tax bracket. But when I look at the top tax bracket, 400,000 came along a lot earlier before you hit the top level, depending upon whether you were single or married or what. So he gave me some good information that I thought I would share with you.
Regarding your other question, I don't think anybody has really come up with any firm idea of it. The 400,000 comes from the fact that the original act back that had established the 39.6% bracket used 400,000 as the threshold for going into the highest bracket back when it was 39.6%. So some suspect that if we were to roll back to where things were prior to the Tax Cuts and Jobs Act, we'd be looking at a 39.6% rate that again would start at $400,000. But that's just a bunch of people navel gazing and speculating about where things might go. There certainly have been no proposals with any specific dollar amounts at this point at all. So I think it's more, I think your most honest answer that you could give, or the most honest presentation that you could give, is that, you know, there might be at dollar amounts yet to be determined an increase in the rates, but to even peg it at 400,000 would be so speculative that you might be stirring up more trouble than it's worth. If that's helpful enough, if not, feel free to give me another.
I thought it was important that I cut it off before he gave his cell phone number. So anyway, I love the comment about navel gazers. But so you're going to see the number 400,000 in this presentation, but it's always going to be a little fuzzy or with a question mark, because we've got to try to peg something somewhere, right? So let's take a look at some of what we're looking at. So households above something like $400,000, they're talking about moving back to the 39.6% bracket as opposed to the top bracket stopping at 37. We make this a little fuzzy because we don't know what that number is going to be. The other thing that is being talked about at the $400,000 level is Social Security kicking back in. And of course, the total is 12.4% this year. Half of that would be paid by the employer and half by the employee, just like it is right now at what is under 12.4 or excuse me, what is under the current hurdle of $137,000. Additionally, we are looking at phase outs of tax deductions. We're looking at a cap of 28%. Again, all of this is speculated, but they're just things that are being discussed. The old P's limitation, where you look at what of the AGI is over a certain amount and then take 3% of that, and then that's the amount that you reduce your itemized deductions by. They're looking at bringing that back in. Qualified business income taxes or income deductions coming down, being phased out. One of the ones that for the super wealthy is going to be challenging is having potentially income over $1 million, at least your capital gains and your dividends no longer being taxed at a preferential rate of 20%, but instead being taxed at potentially 39.6%, in essence doubled. So obviously a big deal. And then for businesses, while we're focused primarily for this presentation on individuals, your corporate income tax rate, they're talking about that going from 21 to 28%. So a lot is out there. So when you pull all those numbers together, what does that look like? Well, currently at a level of $400,000, you're looking at a total for earned income, a total marginal tax rate of about 39.35. And of course, 1.545% is also being paid by the employer on that. Taxable interest, 37% ordinary income tax rate plus your 3.8% potentially applicable net. You're looking at 40.8% and then 23.8% on long-term capital gains and dividends. So what are we looking at if some of these things we're hearing comes into play? Well, you're looking at your taxes on earned income going up almost a total of 10%. That's a pretty big deal. You're looking at taxable interest going up a little bit, 3%. Long-term capital gains and dividends at just the $400,000 level, that's about the same. And then of course you've got all the deduction caps and all that we talked about. But in addition to that, and again, this is that big deal, if in fact the unearned income over $1 million, the provisions regarding long-term capital gains and qualified dividends come into play, you're looking at that doubling. So a pretty big deal for many of our clients. So to recap, the key numbers that are being thrown around out there are 400,000 with an increased top tax rate of 39.6, maybe starting at 400, maybe starting at what is currently the top tax rate hurdle, maybe lower, who knows, but 39.6%. What we're hearing is that is probably going to come back in as the top tax rate, just nobody really knows where is the top. The additional Social Security tax starting to come back into play at earned income of $400,000. That's a little more iffy, but you know, they've got to figure out some way to pay for that. So maybe this is it. We'll see. Capping tax deductions at 28% benefit, even if you're in a 40% or 39.6% tax rate. We're hearing that sounds like it might come through. The P's limitation on itemized deductions, that again is also sounding like it might come through. Qualified business income deductions phase out, nobody really knows. The big question mark again is that $1 million mark, and for long-term capital gains of over 400,000, again, whatever that magic number may be, seeing that tax go from 20% to 39.6% is a big deal. And for clients who have concentrations, for clients who have low basis assets, obviously charitable giving can become very attractive for them. Now, again, let me reiterate, we don't know what's going to happen, but we've also seen in the past and could see now that certain aspects of this could be made retroactive. So it's an impossible situation to do planning in, almost, when you don't know what's coming down the pike, and they could make it retroactive as well. But while tax planning and tax brackets and whether or not there's preferential treatment for capital gains and dividends or not, regardless of all of that, those aren't the only considerations that come into play with charitable giving. You have to look at everything together. And these are, from my old world, these were some of the guides that I looked at when I was trying to figure out for a client who was charitably inclined, what were going to be the best tools for them to use. So yes, their tax bracket is obviously up there. But now it's also, can they use the standard deduction, or are they just getting slightly over it? What are their income needs? We all know that you can be in a high tax bracket but still have low cash flow. What about variability of income? Do they have a low basis in assets or a concentration? I remember in my world, and I'm obviously going to be dating myself with this, but I remember working with numerous IBM retirees, and they would never, ever sell their IBM stock. And that was a really good thing to do for a long time. And then it tanked. And then it was not such a good thing. And so, you know, it's really hard to talk to folks who have grown up in the world of UPS and Home Depot. Even now, it's really hard to look at that stock, Genuine Parts Corporation, and suggest diversification because it's done so well for so long. But even the best of the best at some time take a tumble, and that concentration, you know, we used to say that concentration is what builds your wealth, but diversification is what keeps your wealth. So just food for thought. liquidity, huge deal in looking at charitable planning. We work with clients all the time that are looking at not just making a difference now, but they really want to make sure their dollars are being used to make a difference in the future, or using their charitable dollars to teach their children and their grandchildren how to give. So is that part of your client's interest? And then how comfortable are they with complexity? There are some techniques that are really simple, and there are some techniques that are really not. And we all know that we've got those clients who aren't going to go for anything that they can't understand in 5 minutes. And then you've got those that thrive on complexity. So we've got some suggestions for both, but in all of these, you have to keep in mind, okay, what do we think might be coming down the road? And should we be looking at this, doing some of these actions now, or maybe hold off until we see what's coming to pass? So let me start off before we start talking about techniques, charitable planning techniques. Let's look at asset selection. I cannot emphasize enough, please, please, please do not assume your client knows or remembers that you told him or her that they should always look to give low basis assets before they give cash. I can't tell you the number of people that we know, that you know, that, and you probably are seeing this when you're gathering information from them, that you told them to give low basis assets, but they didn't do it. They gave cash instead. And I'm going to give an illustration of why that's so important. So look at what it is they're deciding to give. And for those clients who are over 70 and a half, and yes, they can do a QCD at 70 and a half, they don't have to wait until they're 72. Even if 72 is their RMD mark, that's also a great asset to use for charitable planning. And then don't forget the illiquid assets. While working with charitable gifts and closely held businesses can be messy and complicated, it can also be incredibly worthwhile. But don't forget real estate either. So when I look back on my time where I was working in a financial advisor role and working with many of you, these were my favorite techniques. Obviously, the simplest of all is just to make a gift outright. And there are times to do that and times not to do that. And we'll talk more. An IRA qualified charitable distribution, the QCD. Again, you do not have to be over 72 in order to do that, even if your new RMD date is 72. And one thing that I would encourage folks to remember is that you all know you cannot do a QCD with a donor advised fund or a DAF. But there are other kinds of funds that may make sense for a qualified charitable distribution. Charitable remainder trust, charitable lead trust, just the opposite we'll talk about. Bunching, you guys have probably heard that term ad nauseum. Donor advised fund, I want you to hear that term ad nauseum. And then private foundation, we'll talk more about that. Okay, so when you look at asset selection, these are the two broad categories: cash, then you've got stock or other marketable securities, and illiquid assets, often real estate. Cash, that is the most expensive asset that your client can give. If I take $100 out of my pocket and I put it in a charity's pocket, I took $100 out of my pocket and I put $100 into their pocket. There's no leverage. It's easy, but it's also the most expensive from the donor's perspective. Now, we know that last year and this year, you've got this unique situation where folks can give up to 100% of their AGI and take the entire deduction in the current year and not have to carry any of that forward. Doesn't apply to a DAF, but with respect to other forms of public charity, it does. So I'm curious, and we're going to ask a poll question here. I'm very curious, have any of you ever had a client to truly give away 100% of their AGI in a single year? I have never seen it. So let's take a look. Okay. All right, well, we are 100% no. So I'm going to assume that we had one client in another of these sessions, one out of all the participants who had said that they had seen a client give away 100% of their AGI. But, you know, I see that and I just wonder what is the government thinking? Does anybody really do this? All right, so let's talk about giving away stock. So, or low basis assets. With low basis assets, when you're dealing with a public charity, you can only deduct 30% of your AGI in the form of low basis assets in a current year. The rest is carried forward up to 5 years. But here's the thing, with a low basis asset, let's say that I own ABC stock and I bought it decades ago and it's gone gangbusters, and I bought it at $10 a share and now it's worth $100 a share. So when I go to sell that stock, I've got a $90 gain, and that $90 gain, who knows what it's going to cost me, but let's just say it's going to cost me $30, which is probably not that far off when all is said and done. So my so my $100 stock is worth $100 less the taxes I'm going to have to pay if I sell it. Because if I want to do anything with it other than hold it, I've got to convert it to cash. But to convert it to cash, it's going to cost me $30. So what is my stock worth? To me, it's worth really $70, not $100. But if I give that stock to charity, it's worth $100 to that charity because they're going to sell it and they aren't going to have a capital gain on it. So from my perspective, it is a less expensive asset to give because it is only worth 70 cents on a dollar in this case for this particular situation, whereas cash is worth 100 cents on the dollar. Then let's take the last category, and that's real estate or illiquid assets. So I love the concept of giving real estate, particularly if it is non-productive real estate. I used to have many, many clients. My father used to be one of these who had this big parcel of real estate and it cost him money. It wasn't earning him money, it cost him money. He had to maintain liability insurance. He had to maintain property taxes on this property. And so there was very little benefit to him. And there wasn't even a small 1 or 2% dividend. It was all net cash out of pocket. Well, that can make it an even more ideal asset to give because not only do you potentially have a gain in it, and therefore you're already leveraging the fact that the charity can sell that parcel of real estate and not have to pay any capital gains taxes, but you're also not taking additional dollars out of your pocket in order to have to pay whatever expenses are associated with that asset. So one catch to keep in mind with that most public charities, and we would be included in this, if somebody wanted to gift real estate, we are going to require that they give a little bit of cash to go with that because we don't want to have to come out of our pocket either for those expenses that are going to have to be paid. So usually that's a negotiation up front, but that can be a great asset for gifting purposes. All right, so let's jump into the techniques now. So qualified charitable distribution, you probably are all very familiar with this. Again, you can do it at 70.5. You don't have to wait to 72, even if that is your new RMD. The key with a qualified charitable distribution is that the donor is instructing the IRA custodian to send the gift directly to charity. It goes around the IRA owner. It does not go to the IRA owner who then turns around and gives it to charity. It has to go, the check has to be made payable directly to the charity, like we said here. Now, you've probably had clients, as did I, who said, well, what's the difference if I take it in as income and I turn around and do a charitable deduction? Well, there's all kinds of reasons. One of them is that charitable deduction may be limited to 28% as opposed to a higher income tax bracket under the new laws. Who knows? But it's also going to allow you to make use of the standard deduction. You know, we've got a bunching slide coming up, but just a reminder that yes, with that standard deduction, again, if you've got clients who are let's say they're married and over 65, which they would be if they're looking at an IRA QCD, then their total standard deduction is $26,450. If most of the deduction that they would be taking to get them over that standard deduction mark is going to still keep them under $26,450, why bring this into your income? Why use any of your standard deduction at all? Let the standard deduction take care of all of what would ordinarily be itemized and keep your IRA QCD out of your income, and you've got the best of all worlds. You know, there are so many other taxes that are pegged to your AGI, and of course your IRA qualified charitable distribution it stays out of your AGI. So some of those taxes are the extent to which your Social Security income is taxed, the amount of your Medicare premiums. You know, it could keep you out of that 3.8%, it could keep your AGI below the 200 or 250, which triggers when INIT is going to apply. Obviously, it could potentially result in a lower tax rate for your capital gains, keeping you from going into the 20% capital gain rate and keeping you at 15, or heaven forbid, 39.6. So I said earlier that you can't use a qualified charitable distribution with a DAF, a donor advised fund, but here's what you can use it with. At community foundations, we have designated funds, which is a fund where a client says, I'm going to put this in this fund, and the only place assets in this fund can go are to that charity. Think about your clients who have made a multi-year capital campaign commitment to their church, to a local charity, but they don't want to give all the dollars at one time to fulfill that pledge. But they might want to take their IRA QCD and go ahead and set them all aside and put them in a designated fund, not a DAF, but a designated fund that pays that distribution out year over year. They could also start a field of interest fund, or they could contribute to a field of interest fund, a COVID-19 fund, a diversity, equity, and inclusion fund. There are all kinds of funds that they could contribute to. They aren't going to have the same level of advisory role that they do with a donor advised fund, but that doesn't mean that their only other option is to give it directly to the charity. So a couple situations in which we know that a QCD is going to be a great technique. So first, it's appropriate for clients, and again, you know the total picture, so you've got to determine what's appropriate. So it may be appropriate for clients who are in a high income tax bracket. It may be appropriate for clients who have few deductions. Again, they could take really great advantage of the standard deduction. It could be appropriate for clients whose income is up and down. And they could combine, particularly if they combine it with what I call an INDAF, something other than a donor advised fund, but still a fund that is not going directly to charity. And it can also be a great tool if it's combined with a fund other than a donor advised fund to help your children and your grandchildren learn how to give. We've got a number of clients who use different types of funds with us to engage other family members in giving, both now and into the future. Charitable Remainder Trust. I need to give some credit here to Fidelity Charitable. They may be a competitor, but I think it's absolutely wonderful that they put all these great graphics out on the internet where we can use them as long as we give them proper credit. So the way a Charitable Remainder Trust works is that an individual is going to make a contribution of assets ideal assets for a charitable remainder trust can be low basis marketable securities. And they're going to take back an income interest. And typically it needs to be at least 5%. And there are all different ways to calculate this, but most commonly people use a charitable remainder unit trust, where whatever that fund grows to each year, they're going to take 5% of it out, and they're going to take that into their income. The beauty of it, though, is that the asset that goes into the charitable remainder trust and then is liquidated in the charitable remainder trust, it is creating a gain within the trust. And some of that gain may pass back out to the individual, but it's not all at one time. They can only be taxed with the amount up to which they receive every year. So if I create $100,000 unit trust and I take $5,000 out that first year, my tax is going to be limited. Now, the nature of the tax is going to vary, but the amount that's going to be taxed is only going to be $5,000 in terms of what's taxed to me. So this trust can continue for, if it's a term of years, it's a maximum of 20 years, or it can continue for an individual's lifetime or joint lifetime. But you have to be sure that the value of the future interest that is going to charity, it's a charitable remainder trust, so the remainder goes to charity, that the present value of that is worth at least 10% of the amount that's being contributed. And that is the amount that your donor can actually take as a charitable deduction. They also can change charities. They can change their mind as to which charities that it's going to. So this can be a great tool for clients who need income. So you think about, we used to have clients who had Coca-Cola stock who at the time was paying about a 1% dividend. And that was all these clients had, was Coca-Cola stock that pretty much had a zero basis. Charitable remainder trust was ideal for them because they would take their Coca-Cola stock, they would put it into the charitable remainder trust, whereas before that, 100,000, 500,000, $1 million of Coca-Cola stock was generating 1% in terms of a dividend. They could diversify it within the charitable remainder trust, not have to pay a significant capital gains tax, at least not all at once, and they would take out their 5%, so they'd get 4% more on the investment each year. The taxability was a function of a number of things, but again, the most they could be taxed with was that 5% distribution, whatever it was. So it can be a great tool. If somebody's illiquid, doing it with real estate can be awesome for the client. If they've got low basis assets, if they've got a variable income and they want to flatten it out, it can also be ideal. And they could also turn this into a generational vehicle by naming a donor advised fund at a community foundation. This can go to a donor advised fund, that remainder amount. And then you can involve the kids, the grandkids, whomever, in making decisions at that time. So this is one of the favorite tools of planners out there. And by the way, we can serve as trustee of a charitable remainder trust. So a charitable lead trust is just the opposite. So with the charitable remainder, the charity gets the remainder. With the charitable lead, the charity takes the lead. And so again, thank you to Fidelity Charitable for giving us this great graphic. So with a charitable lead trust, the donor puts the assets in the trust, and then over time, the trust makes payments to charities. And then at the end of that period of time, the balance goes back to either the donor or to named beneficiaries. I've seen this used where it actually was used for generation skipping purposes. So we're getting into some pretty complicated tax planning there. But basically, grandchildren were given the ability to designate which charities were going to receive that 5%, whatever the rate may be, during the lifetime of the trust. And then at the end of that trust term, what was left would go back to those grandchildren. A donor advised fund can be a place where these distributions are made. Now, this is a slightly more complex vehicle. And the rules around the tax deduction or the deductibility of the original contribution are a function of how it's going to be taxed going forward. So the grantor, the person who establishes the trust, can take a tax deduction for the present value of that charitable interest, that stream of income that's going to go out to a charity for whatever the term of the trust is. But then the trust becomes what's called a grantor trust, which means everything in the trust is taxed to the grantor. May not be what you want to see happen. But you can also create a non-grantor charitable trust. And oftentimes you'll see this as a testamentary vehicle in someone's will. So there's no tax deduction available for the present value of the charitable interest. Everything is taxed to the trust, but the trust does receive a deduction for its charitable distributions. And again, this can be ideal for somebody who is looking for an estate planning tool. So this is a great tool for those who are legacy focused, who are long-term focused, who are trying to save money from an estate tax perspective or generation skipping taxes, but you just have to be really careful about those income tax implications. All right, bunching. Oh, how many of you are so sick of this term? Anyway, bottom line, if you've got a client who is, close to going slightly over that standard deduction amount, this was actually from last year. And this slide, it gives you an example of somebody who's doing $10,000 a year worth of charitable donations. There are other deductible items only came to $15,000. So their tax savings from their charitable contributions or their deductions overall was $210 a year. If instead they lumped them all together and did it all up front, and then took advantage of the standard deduction in the next 2 years and did all their charity all in 1 year, they actually saved $7,200 in taxes. Donor advised fund, perfect vehicle for this. Again, when is this going to make sense? It's for your client who's got few deductions. It's the client who is just getting marginally over that standard deduction amount, or even staying under it with their charitable deductions. Donor advised funds, our favorite vehicle. And this, by the way, is our graphic. So the way a donor advised fund works, of course, is that the donor is going to make their contribution to their donor advised fund. We call it here a giving fund. And again, that contribution can be cash, it can be low basis marketable securities, it can be high basis marketable securities, it can be real estate. And the year in which they make that contribution, they receive a tax deduction for the fair market value of what they gave, no matter what that gain was, and no matter when they decide they're going to request that we make grants out of that fund. So as long as the dollars are in there, they are preferably growing. They are invested. We have several different options available. We are the one who are handling all the administration that goes along with this. They can add to it at any time, and when they do, we're going to send them a gift confirmation letter that they're going to give to you when they fill out their tax, whatever it is you're having them complete. And then they're going to grant to the causes they care about when they're ready. We love, and it is Barbara's job and her favorite part of her job, to work with donors to help them figure out where they want to grant dollars. Our fund holders can grant to any 501c3, not just to those in Cobb County, but that is where our expertise lies. And some of the stories, and I would encourage you to take a look at our blog about how Barbara's gone about helping donors to identify organizations that really they end up having a true passion about, is just some great stories. But this is a great vehicle. Your ideal candidates for a donor advised fund are those that may be having a particularly high income year. We know that corporate or commercial construction companies are doing really well right now. Home builders are doing really well. Real estate agents are doing really well. And what we tell a lot of folks is put the money away, get the deduction when you need it, But then when years are bad, you can use your donor advised fund to keep up your same charitable giving with the same folks that you've given to in the past. Think about your clients who may be retiring this year. Oftentimes there's going to be a huge amount of deferred income that's coming in. So we really, really encourage you to give that some thought as well. Those that are exercising stock options, they're anticipating a sale of real estate or business. So let me mention this one right here. You cannot, you're not supposed to put money into a fund when the deal is already struck. But when you're thinking about the sale is the perfect time to go ahead and make a contribution of an asset that you anticipate selling at some point in the future into a donor advised fund. It's a great diversification tool, and we actually have a number of companies that have set up donor advised funds where they will either match what their employees put into the fund, they'll put a certain percentage of their revenue into the fund, and they can include their employees in determining where those dollars are going to be granted. So to recap, a donor advised fund, it can be appropriate for a client with a high income tax bracket with few deductions, with variable income, so they can keep giving in the low income years and keep the charity sustained that they want to help sustain in their low income years, not just their high income years. Great for low basis or concentrated assets. Clients who are illiquid, they can give illiquid assets to a donor advised fund. And again, you can use it. We've got so many clients who use their donor advised funds as a way to help teach children and grandchildren about charitable giving and bringing them into that conversation. So our last, I think this is our last technique, is donor advised funds versus private foundations. Many of you probably have clients who have private foundations, and this is a side-by-side comparison of donor advised funds versus private foundations. And I would tell you that I had clients who had private foundations and they ended up closing them out because they really didn't want to take the time to running them. The limits on what you can deduct with your current year gift are lower than with a donor advised fund. I think one of the really important things is your valuation on gifts, that you can give a publicly traded security at its fair market value as opposed to cost, but anything that is closely held or not publicly traded real estate, you're giving it at basis. With a donor advised fund, you don't have to give away, there's not a mandate to give away 5% of the assets. There's no excise tax on the income. There's no filing of tax returns because we take care of that. There's no record keeping on the fund holder's part of who have I given to. We take care of that. And all of the information about where a fund holder gives, that is anonymous. If they want their, first of all, when we file the 990, for us, it's being filed for all of our donor advised funds. So nobody knows which fund gave to which organization. And the other thing is that as it relates to when the charity receives a check, if the donor wants it to be completely anonymous and all they know is that they're receiving a check from a fund holder at Cobb Community Foundation, that's all they need to know. But I have to tell you, one of my favorite quotes around donor advised funds was made at an Atlanta estate planning conference meeting a couple years ago. And Ben White of Alston and Bird and Alicia Phillip, who is the former CEO of Community Foundation for Greater Atlanta, we're talking about we're talking about private foundations. So Barbara, why don't you lay out our second poll question? So they were having a conversation, and Ben White used 4 words to describe family foundations. So let's see if you can guess which 4 words he used. A pain for CPAs, a pain for all involved, a best alternative for clients, or a pain in the... Well, 100% of you are pretty close. you said pain for all involved. It's actually a pain in the bleep, but he didn't say bleep. But I got to tell you, I wrote that down, and I have saved it and quoted him so many times because I just think it's a great quote. So who in the world is a private foundation appropriate for? You're going to have clients who like complexity. They're in the minority, but those who do, they really do. And they also want full control. With a donor advised fund, whether it's with us, with Fidelity, with the Atlanta Jewish Federation, Community Foundation, National Christian Foundation, all of us have what's called that variance power, which says that if we believe that the fund is not being used for charitable purposes consistent with our mission, we can insist on a redirect. We've never done that. Most organizations, most community foundations do not. But if someone is uncomfortable with that language, then a private foundation may be a good tool for them. So this is a page that I put together as we were preparing for this, because it occurred to me, if I had had something when I was in your shoes where I could kind of look at a grid and say, okay, they are like this and they're like this, and what does that bring me to? Oh, but they're also like that. How does that play into the equation? That would have been really helpful to me. So we have put that together for you and hope it's helpful. So this is basically just a compilation of the information that was presented on each of the slides earlier when we said in the upper left-hand corner, the qualities of the client that might be a good fit for this particular technique. This is just a compilation of that information. So hopefully that'll be helpful. You know, we haven't really talked about estate and gift tax rates, and we're not going to talk a lot, but I will just tell you that what is being discussed is a lowering of the estate tax exemption. We've seen both the numbers 3.5 million and 5 million. I'll tell you, in all of history, we have never seen the estate tax exemption go down. Even though the Tax Cuts and Jobs Act is expected or gets repealed, I guess, in 2025. With that, there has still never been a reduction in the estate tax exemption. So we'll see. The top tax rate that is being bannered around is 45%. Lifetime exemption for gifts of $1 million. That makes things much more difficult. The other thing that we're hearing, which we've heard before and we've never seen happen, is the elimination. Actually, that's not true. It did happen once. Elimination of stepped-up basis at death. Can't imagine how you would administer an estate if you didn't get a stepped-up basis at death. But that lifetime gift tax exemption combined with a potential reduction at those levels in your estate tax exemption, that would be could be devastating for some families. So please be mindful of that in your planning. Favorite testamentary planning tools, it's really much of what you already saw, it's just using them a little bit differently. And really that is a subject for another webinar at another time. So with that, I'm going to turn it back over to you, Barbara, and I'm going to stop sharing my screen. And you can talk about why for some of these charitable planning techniques, they may want to consider Cobb Community Foundation. Oh, you're still on mute.
That's not a good thing. Thank you for catching that. You
Sure.
think after a year, right, I would have this down. Oh my goodness. Thank you, Sherry, for sharing those charitable strategies. And we certainly hope that those are helpful to you. We know many of those are probably refreshers, but it never hurts to hear it again and again, right? So I'd like to give you a small break from the numbers and oops. Let's see. And give you just a highlight reel of there are no words. The generosity that we saw in 2020 and into 2021 from the Cobb community and beyond has just been unbelievable. And the timing is perfect because we have just released our 2020 impact report. So yes, are we a part of this? Certainly, but this really tells the story of just how generous, completely generous this community has been. So we just want to give a couple highlights here. So like so many of you locally and really around the world, we had no idea what 2020 would bring when it started like any other year. A couple months in, boom, everything just completely changes. We had partnered with Georgia Center for Nonprofits and through funding from these generous individuals to complete the Cobb Human Services Needs Assessment in 2019. Because we had a lot of people asking, okay, so how are you making these grants? And we wanted the data behind the grants. So this needs assessment came back, helped us identify Cobb's most pressing needs, the nonprofits who were addressing those needs, and really helped us develop recommendations for funding in collaboration to truly make a lasting impact here in Cobb and beyond. The study identified and illustrated via this heat map here and many others, the greatest disparities were in educational attainment, workforce, economics, housing, and health. And through this heat map and many others, you will certainly see over and over again that South Cobb and South Marietta are really those red zones. The most need is there. So we're armed with this amazing data. We're ready to roll out our plans to target grant dollars to these red zones, and then COVID. So we've got amazing data, but we need boots on the ground information. So CCF initiated and actually led what began as daily calls with senior leaders from all of these participating organizations. And that was not crack of dawn, but just about. So Sherry is on that call for an hour, 7:55 to 8:55. Initially, like I said, every morning, and they're just trading stories. Here's what's going on with food. Here's what's going on with housing, unemployment numbers, COVID numbers are spiking. And that's where we were finding out literally day by day where those greatest needs were, and then matching what became COVID-19 grant dollars later. So was good stuff. Another big thing that actually began in 2019, we released what we call the Cobb Community Connection. And there was definitely a need for this, but we had no idea how great the need would be again when COVID hit. So Cobb Community Connection is a searchable, mappable online directory of nonprofits who are either in or serving Cobb residents. And this helps them find resources for, financial resources, medical, all kinds of different resources. Or if you are looking to volunteer, you're looking to donate furniture or dollars, you can go here from that regard also and find out what all of your different choices are. If you want to volunteer with your 6-year-old, whatnot, you can say, I'm available on Saturday. I would like to volunteer something to do with homeless. It will come back and say, these are the 4 charities, nonprofits that you would be interested in. So it's been an amazing resource all along, but again, especially last year, the number of visitors to the connection increased 300%. We had over 35,000 views, which is huge. And of course, the large majority of those were folks looking for resources. Another way that we were pointing folks to that connection is this way: 75,000 connection cards we had printed in both English and Spanish, and those were distributed in food boxes through our nonprofit partners, through local school systems and the county government to again help drive folks to that website so they could find out all of the resources that were available to them. So yes, then March 2020, we realized, okay, this thing is not going to be over anytime soon. We need a fund that can really address these needs. That fund was initially seeded with funds from our 2020 Corporate Community Champions here. We were going to go a whole nother direction, again, addressing those red zones. COVID-19 just totally derailed that. So we ended up with over $400,000 in that fund that came from 900 plus contributions. Some of those were as small as $5. So it was really, really heartwarming to see even folks that didn't have a whole lot to give were contributing what they could. We saw $10 recurring contributions. And of course, we had larger ones, some as large as $10,000. But we ended up distributing over $300,000 last year. Of course, holding back some of those funds because, again, it's not over. There are still great needs, and we're still distributing funds based on those needs. So we, of course, have a lot. I'm trying to watch the time here. Let's see, I've got a couple minutes left. We've got amazing stories to tell. One of our favorites is one of our nonprofit partners, Sweetwater Mission. I don't know if you've heard of them, if you're familiar with them, but they do a client choice pantry, typically where the folks who are in need of food or other resources come in and they say, you know, I need bananas and I need bacon, and these are the things that I would like to have. Of course, with COVID safety restrictions, that was no longer possible. So they went to a delivery model, which of course requires a truck, and that truck has to be refrigerated. They didn't have a refrigerated truck, and of course they needed one. Another thing that was big is they were one of the few nonprofit partners who were delivering to those red zones. And again, that's key, even when we're not in COVID times. So when Sherry became aware of that need, $10,000 immediately went out in grants from our COVID-19 fund. And then we got on the horn with some of our fund holders. And within a matter of a couple of weeks, we had granted out an additional $36,000 in funds that allowed them to buy a used refrigerated truck so that they could deliver food to those key red zones. And that has been amazing. Cobb Community Food Fleet is another thing that we were just so proud to be able to step into that. Think back to the beginning of COVID. I remember talking to Sherry about it, saying, did you see the news last night? They're just pouring out all of this milk, and they're throwing away meat products and tilling under produce. And it was just heartbreaking, because especially when we're hearing every day, getting all of these calls, seeing all of these needs and people needing food, families going hungry, and then seeing this food go to waste. So the USDA had a, what is the program called? I just forgot. You know what?
Farmers to Families.
Thank you, Farmers to Families. I don't know why I forgot that, but Farmers to Families program. So the food was actually free. They were willing to provide the food, but a lot of this had to be refrigerated. So again, we need that refrigerated space. And it wasn't just, you know, a couple refrigerator. We're talking like thousands of pounds, actually what ended up being almost 2 million pounds of food over time. So CCF partnered with the Atlanta Braves, Cobb Galleria for refrigerated and freezer space. Then also SA White, Ryder Trucks, so many partners who ended up fueling trucks and having those additional trucks for just to hold the food. And you can see down here, more than 1.9 million pounds of food, the equivalent of 1.6 million meals for Cobb County alone were distributed by 10 nonprofits, available weekly at almost 50 locations. This was huge, but as big as that is, it was only just under 25% of the total food need for Cobb County. So we actually had some people say, so really, you know, is there really a need here in Cobb County even? Yes, the answer is yes. And without this Cobb Community Food Fleet, a lot of that food would not have been available. So again, we were just honored to be able to step into that role and help that happen. I don't want to go over time, and I'm there. So one other thing that I just wanted to say, Operation Meal Plan, we partnered with the chamber for that. This actually helped keep a lot of these restaurants going strong through some of the toughest days of COVID, while helping feed people through these nonprofits. That was big. We became the first community foundation in Cobb to offer employee assistance funds. So if you guys need an employee assistance fund, we can help you out. Or if you have If you're working with companies who need this service, happy to jump in and help. So Sherry, I know, I'm so sorry. There's so much to get to. We will send a link with this so you can peruse at your leisure. And if you have any questions, we're happy to answer them.
That's great. Yes, we are so excited about our impact report. It really does the best job ever of describing what we do and why we do it. And so, yeah, we will send you a link to that, and we hope you will take a few minutes to read through it. We know how valuable your time is. We're not going to go 1 minute past our deadline. And we just thank you for spending this time with us. Barbara mentioned that we would be sending you a very quick survey. It'll take you about 10 seconds to complete it. We would really appreciate your feedback. Thanks so much for joining us, and we hope you have a great weekend. Bye-bye.
Thank you.